Hey everybody, it's Ken. So thanks for watching. This video was done for all the people that have sent in questions, and a lot of them are, what makes a successful investor? What are your top qualities? So I continue to get this question from you guys, so thanks for sending those in. This is the title of this video, which is the 5 qualities of every successful investor. And many of you guys know that my partner and I have bought well over $1 billion worth of real estate, from raw land to multi-storage properties like mini storage and self-storage, to mobile home parks, to multifamily, which is primarily what we do, to office, and of course we've done condo projects, et cetera, et cetera, et cetera. And so from all our years, these are the 5 things that we think are the most important things for you as an investor, or if you're actually raising money from other people and trying to syndicate the deal. So starting at the top, the very first one is market research. And I think it's really important that you guys use data and not people. So this is a big common mistake. What happens is people start believing, their own. Essentially what's happening is, you're going to these cocktail parties or meeting with a realtor, or you hear these people and they're selling something, and they're what in the real estate world is called puffing or puffery. And so, there's nothing wrong with that. I mean, everybody really at the end of the day needs to, be a bit of a salesman. But it doesn't help you if you're investing on that particular thing. So some of the things somebody might say, Las Vegas is booming and rent growth is 20%. Okay, that is a conversation that could very easily happen. And so do not rely on that. Go back to the data. Now, I talk about this in my book, The ABCs of Real Estate Investing. And what I have in there in chapter 4 is what I call the 3 levels of research. So level 1 is a real property that we bought in Portland, Oregon. So before we decided to invest in Portland, Oregon, we went on the internet actually, and we're looking at what cities do we want to invest in. And Portland, Oregon kept coming up for a multitude of reasons as a city that was going to have incredible job growth based on all these different things that are available to you on the internet. Trust me, there's lots and lots of brokers and property management and title companies that gather this data, and it's out there everywhere, and they pull it from like the U.S. Census Bureau and things like that. There's all these mechanisms and data that gets tracked that tells you, is a city growing, is the population coming in, or is a city not, and it's going out, like what happened to Detroit after, all the big car manufacturers started to shut down. So using data is very, very, very important. So in level 1, you can do all that from your living room or from your home. You don't even need to fly to the city and figure it out. Level 2 in my book, we talk about how we flew there and we started to meet with people. We literally went around the city and just started meeting with brokers and real estate offices and go and get information. And what we found just from that 2-day visit, we only spent 1 night there. It was a plane flight and a hotel. It wasn't very expensive. But what we did, as you guys know, in your own neighborhoods, what you find is that literally on one side of the tracks can be a bad area, on the other side could be a really nice area. And you can't see that from your home or via the internet. And so you need to get boots on the ground, face-to-face, lots of meetings. And here's what I found. Now, you're going to have people that are selling you that, of course, want you to buy something. But you're also going to have the ones that are just going to tell you the truth. You know what I mean? So you just got to weed through all that. But we had, I think 12 meetings in 2 days, and we had all this data. And honestly, it was super confusing because some people were really, really bullish and some people were not. And so, all over the map. And some people said vacancies were here and occupancies were here and rent was here. And, so anyway, you got to sift through all that. But then we went back with all that info and we did what we called the level 3 research, which was now drilling down into the submarkets, because what happens is, you guys know, and certainly this was the case in Portland, there are certain areas of Portland that people are moving out of, and there are certain areas of Portland that people were moving to. And you don't know that when you're just looking at Portland, you know, and you know, it's bordered by a bunch of freeways, and there's a lot of submarkets inside of there. And so you have to know, like there's the River District and the Pearl District, and we were buying in the River District, which is on the Willamette River, and the Pearl District was booming with business, which was kind of joined to it, but the Hilltop area wasn't doing so well, all in downtown Portland. Now, Portland's a big city, so this is just one little area in what they call the Central Business District, the CBD. So, and a lot of that had to do with light rail and all these other things that were going on in Portland. But the point is that we went and figured all that out. And so when we finally got to level 3 and we had the actual data, then we started to figure out exactly what we wanted to buy in that submarket, and then we moved to the next thing, which was looking for property. But we did all of that first, because you can very easily buy literally on the wrong side of the tracks. So on the second one, you know your exit before the purchase. I'm just going to walk you through. This is a very important concept. You need to know exactly how you're going to get your money and your investor money out before you buy the property. Okay? This is not a buy and hope strategy. A lot of people do that. A lot of people think real estate investing is buying and hoping the market goes up. And hopefully that works for a lot of people, but this is not that. This is knowing exactly how you're going to get your money back. So I'll give you an example of a deal that we're actually right in the middle of. So 3 years ago, I bought a 30,000 square foot office building on Scottsdale Road in Scottsdale, Arizona. The average rents in that building were $11.41, and there were about 15 different tenants in it. Okay, so this is an office building on a major road, and it had all the rents were at $11.41. Now, some new properties just one block away were renting in the 30s, $30 a foot. So we're at $11.41, and the ones just a block away are renting over $30. And so that's what we call a value add. So we're like, okay, this could be good. Now, the property was not in great shape. It needed money, et cetera, et cetera, et cetera. So we bought it based on the current occupancy and the current rents. So we bought the property for about $3 million. And we figured that we needed about $500,000 in work. And so we raised $3.5 million in equity, and we bought the property all cash. We didn't even finance it. Okay? So we also knew that all the tenants were about ready to turn over in the next 24 months, which is a very important point. So we knew that we were going to be able to get rents significantly higher. So when we started, we pro forma'd in the business plan $19 increases after they moved out and after we did a little bit of work. So we bought it at $11.41. Our projection was 19. And so now, fast forward 3 years, what we've done is of the 15 suites, we've turned 12 of them, and our average new rent is $23.50. So we are significantly above our pro forma. Okay, so obviously that's been a massive success. We started at $11.41. Now our rents are well over double. And so we take that to the bank. And so now the property is full. We got a couple more suites to do, but it's full enough to where we can go to the bank. And so we went to the bank and we said, how much do you think this is worth? Because the net operating income is a lot higher because the rents have doubled. They said, we think that that building is worth about $7 million. Now, keep in mind, we bought it for $3 million, put another $500,000 into it. So with that, they're giving us a loan for just a little over $4 million to now take out all of those people that invested 3 years ago. So the $4 million loan pays off the $3 million original equity plus the $500,000 plus everybody gets another $500,000 back. So now at that point, literally we are infinite We have an infinite return. It's tax-free because you don't pay tax on a loan, and even though it's a return of capital, you still owe on that loan. So it's a tax-free cash out refinance. And so now all our investors are no longer in the property, but they're still owners. In other words, their investments are back, but they still own their shares. And now we also have $3 million of equity in the property, and it cash flows. So that was a plan that we knew. Now, we thought the rents were going to be at 19, but we ended up significantly higher, which was a massive bonus and just made us look good. And we got a little market rise in as a benefit. But we didn't rely on this. We bought well. We had a plan. And so when we put together the due diligence, which is the next thing that is the most important thing, that's where you figure all this out. What's the market? In other words, we knew it was $11.41 on that particular property, but what could it be and where could it go? And so when you're in your due diligence, and I'll just bring you up on another story. So we bought a 680 unit building in San Antonio. It was 50% vacant, and it was bank owned. So it was a mess, as you can imagine. Imagine there's no way the thing cash flowed, okay? So the reason I use this one as the example is because it was a massive amount of work. And so we broke it up into 3 categories. We said category 1 were units that needed major work, and we determined that there were 50 of those. In category 2 were about 150 units that needed at least 1 month of work. And then the third category were units that we could bring on to the market in just about a week. And so that was the balance of the units. And that was about roughly 150 to 200 more units. So you can imagine it's a lot of work. But each one of those required a different skill set. You know, so the ones that had major renovations were different kind of contractors. The ones that only needed a work were basically maintenance guys that could turn units and clean the carpets or put new carpets in and, you know, and paint the walls, etc. Some of these had major work, some of them didn't have major work, and then the middle category was everything in between. This property had water damage, had fire, had all this stuff, but we bought it for $22 million, and we put another $7 million in it, so it was a $29 million investment. Okay, now in the business plan, in the due diligence, we were also trying to figure out what, you know, were the roofs good, the parking lot, the paint, the clubhouse, all of those things was all part of that $7 million. So we had what we call inside and outside. We knew the place was a mess. We also knew the rents were low as a result of that because it was just horrible ownership and horrible management. But as you guys know, we bought it, and we still own it today. And so we'll roll that right into the detailed business plan, which is how you raise your money. And so after you go through all of these things, you now actually put all those into a package, into a detailed business plan. So using that exact same example, we said, okay, we think it's going to take 2 years to turn around this property. In other words, to actually do all the work in 350 units and get them all market ready and get them all rented. Imagine that, 100 units plus a year, plus the ones that are moving out. So it was a very aggressive plan, but in a little over 2 years, we were able to do this. And so we were able to, with the $7 million, we were able to paint the buildings, do the roofs, do the clubhouse, and then start our plan. We started with the ones that we could deliver in 1 week, and then we started the next one where we could deliver in 1 month, and then we moved to the last ones that took, you know, a lot of work that had just basically been gutted over time or had some major issue with. Okay, and so we slowly worked the list, and we got through them all in just under 2 years, and we re-rented them as we're going, right? So now people are happy because you've got a units with brand new appliances, brand new carpet, brand new paint. You know, they're basically brand new exterior, and the place is starting to look good, and it's now obviously being run by good ownership and good management, okay? So fast forward, this is all very detailed in the business plan. Here's year 1, here's year 2, here's year 3, here's our revenues, here's our expenses, here's what we're spending by month. All that is thought out in the business plan. Because what does an investor want to know in a business plan? If I give you my $7 million, When am I getting it back? That's what they want to know. And more importantly, what's my return going to be? So that's all detailed in the business plan. And we figured that we could return the $7 million back in about a 3-year period, because we figured it would take easily 2 years to stabilize the property, and then another year to kind of get the rents up to market and kind of stabilize or adjust or correct that last bit on the rent roll. So we did that. And so when we brought this property to the lender 36 months later, of course this is all detailed on the business plan, including bringing the property to the lender at a projected net operating income and a projected gross rent and a projected expenses. And we weren't completely perfect on those, but we beat our business plan. We had a much higher net operating income than we thought. And the bank said, we think that thing's worth about $42 million. So we took a $22 million property, put $7 million into it. Now the bank's giving us an appraisal for 42. And guess what they gave us? Our goal, of course, was to get a $29 million loan, because the $29 million loan paid off the $22 million that was to the original bank and the $7 million back to the investors. And then in addition to that, we had about another $1 million to distribute, because we actually, I think, got about a $30 million loan. So that is in a detailed business plan. So it shows the investor, here's when your money's coming in, here's what you'll get on it, if anything, in year 1, year 2, and year 3, and here's when you get your money back. And at the end, you're still going to be a partner, but you'll have all your money back, again, infinite return, tax-free. We still own the property today. It kicks out around $600,000 a year in cash flow, and now it's worth close to $60 million, and we have no investment in it. And so that's how you raise money in a very detailed business plan, and it all comes from the due diligence. And the last thing, I think a lot of times, this is a very weak piece on a lot of investors, is the basic reporting and financial accounting. And what I've seen in the past is we have very, very detailed reports. We have detailed reports at the management level that show the occupancy, the delinquencies, the units that are ready, and how long they haven't been. And we have what's called a make-ready chart. We monitor all the leasing and all the kind of the heartbeat of the community. And so if we're not getting renters there, then it could be a marketing issue, or it could be a presentation issue. So all these reports are super important, and they're all working together. In addition to that, you can imagine we have the chaos of the painting and the roofs and the parking lots and all the stuff that's super disruptive to the residents. And so you do have some people that are upset around that. Some people love it. It's about time. The management's, the ownership's putting some money into the place. Some are like, you're inconvenienced me. I can't, I got a construction worker in my parking space and I'm moving. So you got all that stuff going on. So you have people coming in, and you actually even have people going out, because as we're improving this, the whole idea, of course, is to get higher rent and to have a nicer, better place that's worth more as everyone's happy. So we upgraded our entire resident profile, because we started getting people that made a little bit more money moving in there, and families and things like that could afford a little bit higher rent, because our rents were anywhere from $150 to $200 or more a month. In addition to that, what can really get away from you on a property like this is the maintenance and the construction stuff, because subcontractors are tough sometimes, with their billing, and sometimes they're really small companies. Sometimes you have big ones that are a little more sophisticated, but there's all this stuff going on, like how long is it taking to turn this unit? How much did it cost? We budgeted $5,000 and it cost $6,000. Well, if you make that mistake over 100 units, you made a $100,000 mistake. 1,000 times 100. So those are things that all have to be managed as you're managing the cash all the way through. And at the end of the day, the financial accounting, the heartbeat, is the net operating income. What's the rent? What's the vacancy? How many are left? What's it costing us to run this property? And what's the net operating income? And that's the most important piece, because then what you do is you take that to the bank and you end up getting your exit, which is in this particular case, was the $42 million appraisal and the $30 million loan, which took out all the original equity and all the original CapEx or capital improvements that we made. So at the end, we had this beautiful property that's completely cash flowing. All the investors got their money back in 3 years. And this, in my opinion, are the 5 major things that every single investor should do and know before they're raising capital and putting a deal together. So thanks for listening. So if you guys like what you saw and you want to see more videos like this, and we put out weekly emails and you want to see those, just click on the link below, put your email in there, you'll get weekly emails, and please, please, please tell me exactly what you want, because this video was designed specifically for several people